All right, good Thursday afternoon. Traders and investors, Phenom Group members, and our Phenom Group YouTube audience. It is Thursday afternoon. Tomorrow's Good Friday, so the markets are closed tomorrow. It's a holiday shortened trading week. It's monthly options expiration. A lot of economic data out this week to digest, including consumer price index, the producer price index. Both of them left a lot to be desired in the way of transitory inflation, or simply showing that inflation may have peaked. This morning, we also got jobless claims, which continue to hover at 60-year lows, as well as monthly retail sales, which came in at yet another record level, showing growth each month of this year, despite the calls for a slowdown. With that being said, let's dive right into it. Well, before I forget, have a happy Easter, everybody, and a happy Passover as well for those who celebrate Passover in the coming week. And let's dive into things. Our goal as a trader is to push aside FOMO, create a bubble for yourself, shut out the noise, don't look at other traders, focus on what is important to your portfolio. If you cannot do this, you'll forever be chasing the unachievable. Basically, the message here is there's a lot of noise out there, especially when it comes to the financial media. It's daily, it's a drumbeat. Social media, it's daily, it's a drumbeat. You can't get wrapped up into all of these narratives that you hear and see out there. And if you haven't heard me say it before, keep in mind that whether it's social media or the financial media, it's a business. And it's good business when you can instill fear in others. Why? Because as investors, our primary instinct is to preserve capital, even though we should be investing capital, taking risk. With that being said, kind of want to demonstrate to you just how bad, just how pervasive the financial media can be, right? With crude oil prices, coming off the burner, actually moving below $100 this week, but might finish the week above 100 once again. Just the other day on CNBC, we know that gas prices nationally were over $4.25 a barrel at one point. They've since come back in under $4 a barrel. But how much of an impact does this have on the consumer? How much of an impact does this have on travel and things of that nature? In my opinion, there hasn't been. In fact, we've seen an increase in travel, an increase in leisure and hospitality spending, regardless of the price at the pump. But you wouldn't believe that if you listen to CNBC. I want to play this clip because at the very end of this clip, folks, you got to listen. You got to hear what this guest says, which basically just validates the mantra that I've had for a number of years, which is the media is going to sell you a fearful, cautionary tale day after day after day. Why? Because that is what's going to draw in a bigger audience, and the bigger the audience, the more ad revenue dollars that a CNBC, a Bloomberg, a Fox Business News is going to be able to generate.
Giving up about 4% yesterday. Of course, this follows 2 weeks of declines as lockdowns in China sparked concerns over demand. Joining us with her outlook is Amrita Sen, founder and director of research at Energy Aspects. And Amrita, watching the push and pull of supply and demand with...
Of course, an ad. Bear with me, folks. This is good stuff, trust me. We'll get into our weekly regimen right after this.
With what's happening in Ukraine and the Russia situation versus the lockdowns in China, which one is the more important one? Which one will matter more in the next couple of months?
For the next couple of months, for sure, you are going to see the Russian floatings fall off. We've already seen, based on production data, which of course they've stopped publishing as of pretty much today. For the first 10 days of the month, production was down about 1 million barrels per day versus February levels. So things are starting to come off. The biggest driver so far has been the China lockdowns, but we've seen headlines that some of the restrictions are very slowly getting lifted. Very early days, can't really make a call on how long it's going to take, but we believe our estimates and our sources on the ground do suggest that demand should start to pick up from May onwards. And once that happens, like you said, or asked rather, in terms of the next few weeks, as soon as China starts to come and buy, then the supply losses will bite.
You know, I'm wondering what the tipping point is, because below $100, people seem to calm down a bit. That usually translates into about $4 at the pump for gas for most places in America. Above that, when you were looking at 120 for WTI, with people talking about 150 and beyond, that sparked a real concern about just about how people would be able to pay for some of these things. We've seen inflation.
By who? Who did it spark a concern with? Right? We have no evidence of this. None.
Inflation raging. What do you think the inflection point is?
I mean, look, to your point, the reason why there was so much, even political interest in getting prices below, or gas prices below $4, we've seen the SPR release, right? And enormous, unprecedented volumes of SPR release. Partly why the market has sold off. And to be honest, even on our balances, we have flipped from pretty big draws to a small build in this current quarter because of the China lockdowns and the SPR. So it is working. You know, I was in the US the last 2 weeks. I just got back, and I don't think even at such high gasoline prices, the first week I was there, pump prices were well above $4. It was $4.50 even in the Midlands, and driving was strong. You could see traffic was very, very strong. People have saved up a lot during the last 2 years. People are quite desperate to fly. Airports were packed. So yes, of course, it's going to have an impact over time. But right here, right now, I think it's more the media rather than actually impacting demand.
Did you hear that?
Oil prices are in the green this morning.
I think it's more the media than actual impact on demand. More the media than actual impact on demand. What are you going to do, folks? This is what you have to contend with as an investor, and why create a bubble for yourself. Shut out the noise. They've got to sell a fearful, worrisome, cautionary tale day after day. It drives a bigger audience. Look how scared folks are. This is from the latest Bank of America Fund Manager survey. Our FMS, Financial Market Stability Risk Index, is currently at 6.4. Investors are seeing risk levels comparable to the COVID shock and great financial crisis. The high perceived risk to the financial market stability points to a further decline in equity prices. This chart is the sum of the Z-score. So people actually think that inflation, that Fed rate hikes, that higher gas prices are the equivalent of the COVID shock and the great financial crisis? Are you kidding me? It's how far people have gone. Pay too much attention to the media. They have to do this. It's how they generate ad revenues. You know, in the financial media, they're always beaten up on the Facebooks, the Twitters, the social media platforms, right? For misinformation, disinformation, so on and so forth, favoring the Democrats, favoring the Republicans, you name it. What part of their narratives on CNBC or on Bloomberg can we discount as misinformation also? But that was a perfect example. Anyways, looking at last week, we talked about this week, which is the week before Easter break. And usually the market has a positive return Easter week. Positive, what's that? Easter week, 63% of the time. The average return, 1.23%. Doesn't look like that's happening this week, folks. We're down. It looks like we're going to finish the week on the downside once again. We came into the week at 44.88, and we're below that level here on Friday, monthly options expiration. What about the day before Easter? We talked about that also. That's up 70% of the time. Average return, 0.5%. Does not look like we're going to get that here today. All indices are in the red. They're off of their lows, but it's not looking too good here, folks. We're down about almost 0.75% on the day right now at 2:30 in the afternoon, an hour and a half to go. Holy Thursday, you can call it also, and Holy Thursday tends to be a pretty good day based on this quantifiable edge study. Holy Thursday is one such day that has done quite well historically. And yet here we are today defying the odds. Earlier in January, we talked about this chart right here, or table. These are the bull markets going all the way back to 1942. And these are the number of months, number of years in the bull market also. Now, at January, we were 21 months into the bull market. The bull market started at the end of March in 2020. So at the end of March in 2022, we're 2 years or 24 months into the bear market now. The average, I'm sorry, bull market. The average, that's how bad price action has been this year, right? The average bull market since 1942, the average number of months has been 60 months. We're only 24 months now. The shortest bull market has been 26 months in 1966 to 1968. That was the shortest. So, you know, if the bull market is over, this would be the shortest in history. We're not down 20% from the peak, obviously, in the S&P 500, and it will still take a lot to get us back to, you know, to the lows and beyond, which is certainly possible. But if we're using the laws of averages, suggests that we're not going to be in a bear market this year. The average bull market is about 60 months, going back to 1942. So just wanted to revisit that. We're in, you know, we're going into the 25th month as we speak. We haven't had a new all-time high this year, right? Well, we had one the very first trading day, but we haven't had one since. It's been 68 days since we've had a new all-time high. What are the forward S&P 500 returns when you have not had a new high in 68 days or greater? If we go back to 1950, it's happened 31 times before. The average 1 month return is 1.86%. Percent positive is pretty decent at 68%. If we go out 12 months, market's up 61% of the time and about a 5% return. That's not very good. How do we know that's not very good? Because this is just any time since 1950. 12 months later, market average return is 9%. So there is something wrong here, if you will, that we haven't made a new high in 68 days. It shows the underperformance when you've gone for that amount of time without making a new high, if we're looking out 12 months. Doesn't say that we won't have gains. It just says that probably going to see some underperformance compared to any other time. All right, let's talk about the Nasdaq. Switching gears for a second. Very quick 50% retracement off of the lows. It was actually a little bit more than 50%, right? We were down 22%. And within 2 weeks, the Nasdaq was only down about 9%. So more than a 50% retracement in just 15 days. There have been 12 retracements of 25% or more after 15 days from a low in the Nasdaq's history, which goes back to 1974. Over the next 2 months, there was only one loss of those 12 times that it's had this 25% or more retracement off the lows. Only one loss 2 months later. So here's the thing. It seems like 90+% of the time the market is higher 2 months later. You have a continuation of that rally. Unfortunately, we've already given back some 8%, 9% of that rally. already. We were at 14,500 on April 4th, or 15 trading days off the low. Nasdaq is currently 900 points lower than we were on April 14th. And has a lot of work to do if we're going to see the positive reward over a 2-month period. Got a lot of work to do. But again, the odds are in our favor. What else with the Nasdaq? We talked about this one last week, the breadth thrust, which is illustrated here. What happens after the percentage of Nasdaq component stocks above their 50-day moving average goes from below 20% of them to above 60% of them, right? A month later, this is just 1 month later, Nasdaq is up 3.8%. So where did we start? Where was our starting point? The Nasdaq was at 13,900 on March 23rd when this signal fired. And again, look at the 1 month return. So 13,900, the average return is 3.8%. The positivity rate is 73%. So 13,900. Again, that was March 23rd. So by April 23rd, where are we right now on the Nasdaq? $13,900. We're at $13,400. Just like our prior study, we got a lot of work to do here on the Nasdaq. Right now, what we're recognizing is that a lot of our studies, whether it's the day before Easter, Easter week, we're not living up to the probabilities, which suggests that those macro fundamentals, which are your primary guide, they're laying waste to a lot of these studies. We still have time. Yes, we still have time. Next week could be a really strong week. You never know. But as of right now, we got a lot of ground to make up if these studies are going to come to fruition and deliver on these probabilities and these returns. Rate hike cycles. What's the best index to own after the first rate hike? You might have to take drawdowns. We're not talking about drawdowns. We're talking about, from the start of a rate hike cycle to the end of a rate hike cycle. And this is the Nasdaq. From 1994 was the first rate hike to 1995, it gained 18%. From 1997's first rate hike to 1998, it was up 40%. 99 to 2001, the final rate hike, right? .com bubble, everybody knows. 2004 to 2007 gained 26.9%. This rate hike cycle, right? So that, remember, it's not when the first rate hikes start, because this first rate hike started actually in 2015. But from 2008 to 2019, Nasdaq was up 442%. So how does this compare with the Dow? How does this compare with the S&P 500? Here we are. Rate hike cycle start, rate hike cycle end. Here's the Dow, 213% from 2008 to 2019. S&P 500 fared better, about 30% better. But look at the Nasdaq, almost double what the S&P and the Dow did. So you have a bigger drawdown today in the Nasdaq, right? I mean, Nasdaq's been the loser here this year when it comes to the large cap indices. But look at the potential reward. The potential reward is pretty significant compared to the Spider ETF or the Diamonds ETF. All right, Michael Cantorwitz, of formerly Cornerstone Macro Research, which was bought by, I think, Piper Sandler. Forgive me if it was the wrong firm. He's a great analyst. I've been following him for a number of years, following me. He has this thesis that he's been promoting lately. Timber, falling lumber prices foreshadowing a weakening of housing, which leads to new orders falling, which leads to profits falling, which eventually leads to poor employment. housing, new orders, profits, employment. Now, I've seen this before. For whatever reason, there's this popular belief that lumber prices have some type of meaningful impact on the economy, or S&P 500 futures returns. Here's the chart of lumber futures, and we can see that from 1,200 plus, it's dropped down to 874. This is as of yesterday, right? So that's like a 35% drop. So I wanted to have a better understanding what that might mean, or is there a true correlation with forward S&P 500 returns? And so we performed this study, and while it may not be terribly clear, you see there is a lot more green than there is red on the screen. The criterion that we used was what happens next to the S&P 500 when lumber falls more than 40% over the past year. It happened in 2019, it happened in 2009, 2000, 97, 95, and 1984. It also, of course, happened in 2020, but that was because of the pandemic. So here, like, if you look out 1 year, it's mostly green, right? And we know that this right here so far was the dot-com bubble, had nothing to do with lumber prices. 2019, a year later, would have been 2020. And again, we know that had nothing to do with lumber prices and everything to do with the pandemic that happened from 2019. A year later would put this at April 2020. That's the pandemic. Other than those anomalies, you're green a year later by a significant amount. 3 months later, down only one time. Again, .com. 6 months later, the only down period was .com. I think at best you have a kind of spurious relationship between the S&P 500 future returns and lumber prices falling. And I gave it 40%, folks. It's down like 35% from the peak this year. I moved it up to 40%, and you still can't really generate a strong correlation, let alone negative returns outside of some kind of black swan event. So kind of wanted to debunk that. And don't get me wrong, if housing weakens, a lot of these lumber and housing related narratives are easy to fashion right now from a bearish perspective, because of course you've got rates going meaningfully higher, and you've got the 30-year fixed rate mortgage at 5%, which it hasn't seen since 2011. But any softening in lumber prices are because they were artificially higher. The sawmills in the timber industry, logging industry, is still just coming back. It's part of the supply line that has been disrupted by the pandemic. And I would say over the last 6 months, it's been trying to normalize, but still has a ways to go. So you have these fluctuations in the price of lumber. All right, we talked about inflation hopefully peaking. I actually don't think inflation has peaked with respect to the March data, but I do think it will have peaked in April, simply because we are already seeing some of the underlying variables within the CPI rolling over on a month-by-month basis or month-over-month basis. Anyways, you might remember this chart we looked at in the past. This is the sector and S&P 500 related performance during different inflation regimes. When you are above trend but have falling inflation, which may be the case this year, right? We are way above trend. We're at 40-year highs with inflation, but we may have peaked, maybe in the April data when that comes out, and then start falling. So we would fall into this category, and the best sectors are the defensive sectors. Consumer staples, double-digit return. Healthcare, double-digit returns. Utilities, double-digit returns. Real estate is defensive, double-digit returns. Everything else is basically negative returns, including the S&P 500. And one of the reasons why I think that, we may see that final peak in the CPI come next month is because when you strip out, food and energy, you can see that on a month-by-month basis, the CPI less food and energy has rolled over. Another reason, well, the main reason that you had, the 8.5% annualized CPI is because of energy prices. I mean, we know energy prices went through the roof in March because of the Ukraine-Russia war. And we're already seeing, a big pullback in energy prices since then. They've definitely been volatile, but I think crude oil got to $130. National price at the pump, $4.25, $4.30, and we're below on both of those key ingredients for the CPI. Another aspect that we see within the CPI is used cars and trucks. Look at this. And this is 2 straight months where we have used cars and trucks, the prices are coming down. We always knew that they weren't just going to keep going on forever, but over the last 2 months, they've come meaningfully down. And if that persists and we do have this energy price pullback, along with agricultural prices pulling back, we should see a peak in the CPI and that start to roll over here in the not too distant future. We know that consumer sentiment has been poor, but we also know based on today's monthly retail sales for the month of March that they're still spending. They may not like what they see so far as prices and the consistent price appreciation or sticker shock, if you will, but they're still buying and they still have the ability to buy. Whether it's because they have higher wages or they have a better household balance sheet, more savings, or even a combination of the two, they're still willing and able to absorb these sticker shocks, if you will. Included in this chart above here is the inflation reading with the University of Michigan Consumer Sentiment Index, which came in today as well alongside monthly retail sales, and it had a bit of a surprise to the upside. Don't get me wrong. Consumer sentiment is still in the doghouse, but it's off of the lows that we saw in the previous month. And what we can see by this chart is the 1-year percent change of CPI going up and the University of Michigan Consumer Sentiment going all the way down. So yeah, they don't like prices going higher, but they're still spending. Not all declines in confidence foreshadow recession. In fact, not even close. Here's a period right here. We had a significant drop back in the mid-80s. It was basically 1985 into 1988. Did we have a recession? No. Here we are in 94 to 97. Did we have a recession? No. Here we are again. 98 to basically 99. We have this drop right here. Do we have a recession? No. And we can see the same pattern here. Do we have a recession right now? No. We can't predict the future, but in my opinion, we don't see signs of recessionary conditions at this time. Again, we have the lowest unemployment level in many years. Jobless claims are at 60-year lows. We have 11 million job openings, but only 5 million unemployed, basically. So while there definitely could be a slowing of the economy, as long as there are jobs open and there are people to fill those jobs, that means there are paychecks to be received. And where there are paychecks, there is consumer spending and retail sales. The Fed is going to do all it can do to slow things down. Don't get me wrong. But they're going to be looking at the data month by month. All right, what is this? 2009 to 2022. Those are the annual returns for the S&P 500, folks. Down in 2018, right now, down in 2022. But man, that looks really good, doesn't it? A lot of positives. S&P 500 put together a fantastic run since the 2009 lows. This was put together by Ben Carlson. The S&P 500 was up 15.8% a year from 2009 to 2021. And you may say, well, yeah, that's the Fed, right? Easy policy. The Fed started hiking here in 2015. They didn't stop until 2019. So it's not all the Fed for sure. What it is earnings. Look at earnings, folks. 2009, earnings growth. And yeah, of course, that's a huge number because we had no earnings in 2008. We had the great financial crisis. But 51% growth, 12% earnings growth. We did have no earnings growth in 2012. We still delivered a 16% return. But the next year, double digits, 2% growth in 14. Big decline in 2015. That was the earnings recession, where the market was essentially flat, up 1% if you include the S&P 500 dividend. 2016, right back to strong earnings growth, stronger, slow down in 2019. But the market follows earnings growth. The market follows earnings growth. We had the pandemic, obviously, and then in 2021, earnings were up 110%, again, because you have no earnings here. And we had no earnings in 2008, the year before this big move. Naturally, we've set a high bar, so we're not going to have 110% earnings growth. We're looking for anywhere from 8 to 10% earnings growth in 2022. But the market follows earnings, regardless of what the Fed does. The market will follow earnings over time. If it was just the Fed, right, or central banks, if we look at other regional indices, like the Bank of Japan, look at this, the Bank of Japan Central Bank. Look at this. I mean, this is from 2007, right there, to 2021. That's all they've been doing is being supportive. You have the ECB, you have the People's Bank of China, and of course, our Fed. But look at this. And what did the the MSCI Japan ETF do, which is in the yellow color here at the bottom? With all their central bank intervention, this is what their markets did over that time period. So the argument that this is all Fed-induced is wrong. It's about earnings, folks. It's about earnings. Does the Fed create a policy that stimulates economic growth or sustains economic growth, which would obviously drive profits? Yes. Why would they do anything but? Having said that, in Japan, they have been doing it and they still can't see the same performance because they're not getting the same earnings. They're not getting the same earnings growth that we are seeing in the United States. Speaking of earnings, the entire S&P 500 rally off the March 2020 lows was built on a remarkable reset in U.S. corporate earnings power. Prior to the pandemic, so before the pandemic, the S&P 500 earnings averaged $40 a share each quarter in 2018 and in 2019. So 2018, 2019 averaged about $40 a share. Q4 2021, right, that was the most recent quarter before what we're seeing here now in earnings season. So we go back to Q4 2021, the index earnings were $55 a share. There we go, I think. Yeah, here it is, $55 a share, Q4 2021. And that's 38% higher than before the pandemic. We were just $40 a share. I mean, that's huge, folks. That is huge, 38% higher. The S&P 500 is up 33% on a price basis from the pandemic in February of 2020, almost in line with the 38% earnings growth prior to the pandemic. So basically, as earnings go, the S&P 500 follows. All right, now we get to Q1 2022, which is what's being reported right now, where Wall Street analysts are currently expecting only $51.75 a share. That's right here, folks. Like, we got a problem. This is what they're expecting for Q1, which would be a decline sequentially. It will be up on a year-over-year basis, but a decline sequentially. Here's Q1 of 2021, $49 a share, and they're expecting 51. So it is an increase, but it's a very small increase. And it's a decrease from the previous quarter, which has not happened since the pandemic. So what we have are estimates that are too low. We have estimates that are too low. The problem now is that analysts expect future quarters to show further earnings growth. By Q4 2022, they expect the S&P 500 to earn $60 a share. Right here, well, almost $61 a share. It's $9 higher than right here, folks. That's almost 20%. Clearly, investors don't believe that. So what has to happen right now is this needs to jump. We need to see those realized earnings here during the reporting season get materially higher, if not 10% higher than what consensus analyst estimates are right now, $51.75. We need to see that get to better than $55, which is like a 10% increase from the consensus analyst estimates. So if you wonder why the market just can't sustain the rally, this is one of those reasons. But pretty soon we're going to have the earnings completion of the financials. And then we're into tech earnings season where the majority of the earnings come from. So stay tuned. Don't be disenfranchised by this price action. We knew that in a midterm year, you're going to get this volatility. You're going to get this churn. Most midterm years, the market doesn't bottom until like August, September. So if we do anything better than that, indeed, we're above average. It remains to be seen. Stay optimistic. And as I said at the onset of our state of market, create your bubble, folks. Only let the sources in that you know are unbiased. They're not trying to promote some nonsensical narrative. They're not trying to instill fear, and shut the noise out. With that, I hope everybody has a fantastic Easter. Enjoy the extended holidays, and we'll see you back here next week, Thursday. Take care, everybody.